Before we dive into the 40-year mortgage, the differences are between a 30-year mortgage, how it can affect your house hacks. I'm going to give my 2 cents on the 40-year mortgage, why it excites me when it comes to house hacking. To start off, as far as I know, the 40-year mortgage isn't yet available to home buyers purchasing as a primary residence, which is a bummer. I hope it becomes an option in the near future, because when it comes to house hacking, this will lower your monthly mortgage payment even further than the monthly payment difference between investment financing and the current 30-year fixed rate mortgage. So even though it's not here yet, here's the scoop on the differences between the 40 and the 30 year. When you're looking at a 40 year, your monthly payment is going to be lower than that 30-year fixed rate mortgage. But you will end up paying a little bit more in interest on that 40-year fixed rate mortgage than you would with a 30-year by a whole 10 years. So here's an example with 2 different properties, one with a 30-year fixed rate mortgage and one with a 40-year fixed rate mortgage. Assuming a loan amount of $200,000 with a 6.5% interest rate, we'll call property 1 the 30-year fixed rate mortgage. This would be a little bit over $231,000 over that 30-year loan term, just in interest payments. On the other hand, property 2, we'll call this the 40-year mortgage, that would total a little over $297,000 in interest payments. So property 2 would cost you an additional $65,000 in interest compared to property 1. But with a longer loan term, principal and interest are stretched over another 10 years, so this will result in a lower monthly payment. So with that, here's the difference between those monthly payments. For property 1, in this example, the monthly payment would be a little under $1,200 per month, excluding property taxes, home insurance, and mortgage insurance, just the loan itself. In contrast, property number 2 would have a lower monthly payment around $1,050, saving you around $150 per month. So here are my thoughts on this. Although you are going to pay more interest on this 40-year loan, monthly payment is going to be lower. So when you're house hacking, this will result in higher cash flow. The gap difference between that monthly payment on the 30-year and the 40-year going straight into your pocket. And remember, your tenants are paying for the mortgage here, not you. So that $65,000 extra you would pay in interest, in this example, you aren't paying for. But you are going to receive an extra $150-ish per month in cash flow just from the different loan type. Now, with a 40-year loan term and a lower payment, this means each monthly payment will allocate less towards equity rather than the 30-year. So if you're planning to refinance or sell in say 10 years, your equity in the property with the 40-year loan will be less than that property with a 30-year loan. So keep that in mind. But there's a little hack to this. With the additional $150-ish per month in cash flow from the lower payment, you can take some or all of that and start making extra payments each month towards the principal. This will pay down your mortgage quicker and give you maximum flexibility towards your goals with that property. So essentially, with extra payments, you reduce the loan balance, which will in turn pay off your mortgage faster. By doing this, you don't have to hold on to that property for 40 years until it's paid off. And of course, you can do this with a 30-year mortgage as well. It's important to note when you're refinancing, you can only refinance into a loan with a shorter loan term. So you can refinance from a 40-year mortgage to a 30-year or a 30-year mortgage into a 20-year mortgage, but you can't go backwards, like turning a 20-year mortgage into a 30 or a 30 into a 40. So this is what I mean with maximum flexibility and why the longer loan term is a great option. Who should use a 40-year loan? Because as you can see, that extra 10 years will cost you an additional $65,000 and only reduce your monthly payment by about $150 per month. In my opinion, if you are not going to house hack your property or rent it out at all, you are better off with a 30-year or a 20-year mortgage if you can't afford it. It doesn't really make sense to elongate your loan unless you have no other option or no other choice. The principal paydown is slower, you're paying more in interest, and it's much harder to refinance or sell in a shorter time frame. So if you're not house hacking and it is the only option for you, and you really want to buy that home, it is better than nothing. This 40-year loan option will benefit someone house hacking, not the buyer that is just using this as their primary residence with no intent to rent it out. So take these all into consideration when you're deciding whether or not to buy a home, whether you're house hacking or not. But fingers crossed this happens in my lifetime. So thank you guys so much for watching. If you found value in this video, please like and subscribe. I post twice a week on everything house hacking. Thank you again, and we will see you guys next time.